Okay. Hi everyone. Hopefully the sound level's good. Let me know if this should be louder than the music, hopefully, if I've done it right. But quite a few things seem to be broken when when I went to start this stream. So yeah, hopefully we get through it okay. Yeah, so a bit later than normal on this update. Yeah, normally try and do it within the first couple of weeks of the start of the next quarter, but this time we're a bit further in. We're almost actually at the end of Q1 now, so I'll probably be doing my next report pretty soon after this one, somewhat hilariously. But anyway, we're here anyway. Q4's performance report. We'll be talking about how we did through Q4 and kind of a bit of a summary of how we did through 2021 overall. Talk about some of the big themes and what's happened during the periods, respectively. Before I start, I want to make the usual disclaimers. This is not financial advice. I am not a financial advisor. None of this is a recommendation to you personally. Obviously, I don't know your individual circumstances, your risk tolerance, if you are buying a house or if you're in debt or whatever that may be. So, please don't take this as actual financial advice, and do your own research, your own due diligence, and all of that kind of good stuff. Yeah. Please don't rebroadcast this on YouTube. I do that. That's my job. I think that's pretty much it for the disclaimers, really. So talking about how we're going to go through things, I think you're all probably pretty used to this by now. Go through an intro and kind of a bit of talk about me and my strategy, and how I find investments and kind of build up my thesis. Some markets and performance. So looking at the benchmarks of different markets around the world and how our portfolio performed through the quarter and through the full year of 2021. Then look at some of the kind of goings on within the market and the trading highlights for the quarter and for the year as well. Mainly for the quarter, really, but we'll talk a bit about some of the big things that happened through the year as well. And then looking forward to the future, kind of looking at expectations and how the portfolio is currently positioned as we kind of move in, well, as we're halfway through Q1 now, but as we're looking through into Q1 and into 2022. And then at the end, I'll do a short Q&A. Next week, there'll be a full Q&A, which will probably be the one that gets more viewers. I think that's normally the one that drags on for a longer time. So I'll try and keep today reasonably short, and I'm going to set myself a mental target to finish by 6 p.m., but we'll see how that goes. Yeah, but if you could leave your questions until the end, don't just spam them in chat and stuff. Yeah, I'll try and answer them then. Okay. Also, this will be uploaded to YouTube, by the way, afterwards. So this should be up on YouTube tomorrow for anyone who's unable to watch live. I guess you're watching this on YouTube now if you're doing that, in which case, hi. Okay, so this is me. I haven't updated these pictures. You're probably quite bored of them by now. I don't really take very many pictures of myself, I guess. Maybe I need to take a new one. Yeah, so I've been investing for a pretty long time now, over 11 years. Pretty much as soon as I was able to, really, as soon as I had any spare money and could set up an account. And I've been trading since then. So kind of started just as the financial crisis had hit. So kind of 2010, 2009 kind of period. So not right at the start. I wasn't in before it happened, but I was in during some of it, and certainly in for the recovery and some of the turbulence that it brought. I'm fully self-taught. I'm not fully self-taught anymore, I suppose, actually, because I have a CISI qualification now. But I taught myself most of what I know, and then I taught myself a bit more over the past year or so, completing the CISI Investment Management Level 4 course, which is required by all eToro Elite Pro Popular investors. So yeah, I've done that, but really I invest pretty much based on my experience and kind of my view of the world. I've always been fascinated in markets and economics and politics and business and everything around that really. So I've always been interested in it, and so I sort of taught myself over time really. My CAGR is over 40%. It's dropped a bit from last time because obviously I made less than 40% in 2021, so it has fallen a little bit, but I'm still up in the kind of regions that I want to be in. We'll talk more about that later. I consider myself quite ethical and kind of very focused on the future and what's good for society and the world and consumers and you know a more holistic approach than perhaps what most investors do. So I'm really not just focused on the money, but if we're going to make money, I want to do it in a way that I think is sustainable. Yeah, that's a really big part of who I am and what I believe really. Gaming and events is kind of my background. So I started out working in logistics, parcel company, and then I landed a role in an esports company, managing logistics for them. And then I worked my way through and started doing event management and esports management. So that was kind of my career path. At the same time as that, I founded a startup that did reasonably well, but eventually kind of we gave up on. We also did. I also was a professional gamer for a while, back when you couldn't earn very much money from it. So it wasn't really that professional, I guess you could say. But yeah, it was a pretty abnormal career path. I never dropped out of school, never had any qualifications or anything like that. So really, yeah, kind of a a strange career path to land me where I am in investing now. But I think all of those experiences were pretty valuable and helped me look at how I'm uh, how I'm kind of investing in markets and stuff. It's really shaped my investing style. So I went full time as a popular investor in 2017 and haven't looked back since. So I've been full time for a long time now. I think I was the first eToro popular investor to do that. There's now quite a few of us that have done that, which is really, really cool. And yeah, I have no plans on stopping anytime soon. So in terms of some of the metrics we mentioned just now, my CAGR. So this is the actual number for my compound annual growth rate. So as you can see, a bit lower than before. I think I was at around 44% or something this time last year, somewhere around there. I've been on eToro for over 8 years now. I've got over 110 million assets under copy. So the total amount of money that's copying me at the moment on eToro. So even though we've been in a bit of a dip and some copiers have left, I'm still managing. Well, not managing, but have a lot of funds copying me at the moment. So that's kind of still looking like it's going to be a while before the copy block is lifted or anything like that. I should probably update this copiers number because it actually just ticked below 24,000, I think, today or yesterday. So yeah, around 24,000 copiers and lifetime returns of over 1,500% if you were to have copied me from day one on eToro. So that's not including anything outside of eToro. I appreciate the mods, by the way. Okay, so talking about my strategy and my approach, again, I think a lot of you guys are going to be familiar with this. And I'm actually wondering a little bit if I'm even on the right thing at the moment. Yeah, I am. Okay, cool. Okay, yeah. So really, I kind of am a bit of a top-down sort of style investor, which means that I come up with a theme or a segment that I think is going to do well, and then I kind of drill through different companies in those segments until I find one that I want to invest in, rather than bottom up, which is kind of the other way around to some extent. You're kind of like drilling into companies one at a time until you find something that you like. Yeah, so I think really for me, it's about identifying future trends as the starting point, and I really believe in renewables and things like that. So those are kind of the places that I start out. My background really is in technology and esports, and a lot of kind of emerging trends, cryptocurrencies, NFTs, metaverse. If you want to call that emerging, I think it's already emerged really. But those are all the kind of areas that I look at for future trends. I mean, looking at things like changes in people's diets, changing in people's spending habits, in how people work, where people work. All of these things are things that I'm looking at to try and identify opportunities in the market. I'm also incredibly product orientated and ecosystem orientated. So I spend a lot of time looking at the kind of value that the ecosystems and products that these companies are building actually bring to their consumers and the market, and how disruptive they are. So that can be the ability to upsell or subscription models and things that keep people within the ecosystem for a long time. All of that kind of stuff is really important to look at. In terms of fundamentals, this is obviously another big part of what I do. So looking through everything from the management team through to obviously the financials, balance sheet, and how they're really allocating capital within the company, and the structuring of their debt. All of that kind of stuff is also a part of how I investigate the companies that I'm looking into investing in. So yeah, quite a lot goes into it. On top of that, there's ESG. So I've always been kind of ethical, and I don't really use any kind of benchmarking software or anything like that for it at the moment. Like there are different kind of scores and things that you can get for these things for a price. But at the moment, really for me, it's about actually individually scrutinizing the claims that these companies are making of, they're going to go green by 2050 or 2030 or whatever, and what does that really mean, and what have they actually done? Have they taken any of the easy wins? How hard is it for their industry actually to go to become sustainable, and not only in terms of the environmental side, but also the governance and the kind of social welfare side of it, I guess. Not social welfare, but corporate social responsibility. So looking at, for example, the options they have for employees and their ability to actually kind of participate in the growth of the company financially, looking at how staff are treated in terms of working hours and working conditions, all of that kind of good stuff, how these companies look after the communities that they're in. Yeah, all of that is a consideration in how I'm investing. Portfolio fit is the next thing that I'm looking at. So again, like these aren't really in specific order in terms of me kind of going through these things one at a time, but they are loosely in that order. And so portfolio fit is really the next thing for me. So making sure that the position I'm investing in is not overly correlated with an investment that I already have, unless there's good reason for it. Looking at if it's hedging out risk elsewhere in the portfolio, whether that be geographical risk or geopolitical or credit risk, or all of those kind of things. Looking at making sure that we're in a position where the whole portfolio isn't going to be falling at the same time to the same extent, and that we are reasonably well diversified at least. Of course, that being said, it's important not to be overly diversified if we want to actually outperform the markets. Next up is sentiment. A lot of people question me on this one and say, how worthwhile is this, and how do you even kind of measure it? And a lot of hedge funds and things have pretty advanced tools for this sort of thing, and they're properly like analyzing huge chunks of data from social media and things like that. But you can do some pretty basic stuff, like just look at how much engagement some of these companies have on social media, on Twitter and TikTok and Instagram, whatever, and also their web traffic as well. And it can give you some pretty important insights as well. I mean, there was a guy on Seeking Alpha actually who pretty well called what was going to happen with Peloton, based purely on the information that he'd kind of found through monitoring traffic to their website. So that was pretty interesting, and not just their website actually, but some of their servers to some extent. So yeah, that was pretty interesting, and kind of a good demonstration, I think, that looking at sentiment and how people are feeling about a company and how much engagement they're getting and stuff is another valuable kind of bonus to add into your analysis when looking at companies. And then last up is technical analysis. I don't tend to use this too much for stocks, especially. For crypto, it's a lot more important, I find, for crypto projects. But in stocks, really, it's more about adding some more confirmation. I mean, the more indicators you have that are pointing the same way, if the technicals line up with the sentiment and the ESG and the fundamentals and the portfolio fit and the kind of story of the product and the ecosystem and the underlying trend, then that's a really compelling list of reasons to be investing in something. So this slide's really kind of focused on how we were positioned going into Q4. So if you cast your minds back, there was a lot going on in that quarter. It was really the start of the inflation concern. Well, not really the start. I mean, there were people that were concerned about it throughout all of last year and even before that. But really, it's when that started to kind of lift up a bit more. On top of that, we had the rise of Omicron, and again, at the time, nobody knew how severe it was going to be. There was data coming out that it was worse for children. There was data coming out saying that it spread a lot more quickly, which some of these things were found out to be true, and some of them not so true. And so obviously that played a lot in how markets were performing, and also where it spread to and how it spread and stuff. But generally, the positioning of the portfolio was really around a much safer mix overall than I would usually be invested in. Which is somewhat ironic, since the last 3 months have actually been some of my worst performing 3 months for the past few years. But we were actually positioned into some generally safer investments overall. So renewables have always been a big part of my portfolio, but I did increase exposure to companies like Trig, the Renewables Infrastructure Group, who basically just own and operate a lot of solar and wind farms and a few other renewables as well. Really, the point in renewables is what's going on with the energy prices. I was talking a lot about energy prices during that period, and the increase that was expected throughout Europe and to some extent even the US. And so my theory was that although we're not going to see a big kind of rally in all of those names immediately, I do think that through the next few years we should see increased uptake in rooftop solar and increased investment into wind, especially by different nations that are trying to take control of their own energy supply a bit more, and of course meet their targets for being sustainable. Of course, what I didn't expect was quite the reaction that we had to the rate hike talk. So that really hindered that a little bit in the portfolio. Again, like we'll kind of talk about this a bit later, I think. But really, these are very capital intensive things, and so if you're putting up a lot of money up front and you're expecting to get a return of 7% or something, or 8% annually from these kind of massive wind farms or whatever, and a lot of that money is borrowed, then as interest rates increase, then the amount that you have to pay back on that borrowing increases, and the cost of capital is higher, so the return that you're getting is no longer a real return, especially when you account for inflation. And so that meant that a lot of the funding actually kind of did dry up a little bit for these, and on top of that you had a lot of problems with supply chain and with rising wages and things for staff as well. So the sectors actually did really pretty poorly through Q4 and through 2021 overall, but I'm still optimistic about them in the long term. Utilities was the next thing, and this kind of ties in with what's below, which is hedging and dividends. So here I've got a picture of Veolia. They do water treatment and waste management and all sorts of things. The picture is actually an electric road sweeper that they have in the UK, which I thought was pretty cool. But yeah, they do a lot of things. They have a pretty healthy dividend. They just made a big acquisition slash merger, I guess. And yeah, they've done pretty well for us. I built that position through Q4. And if you go and check my portfolio, I believe it's still pretty green at the moment, even though I've cycled a couple of the positions and taken some profit out. Semiconductors and tech. So obviously, I still want exposure to growth. With the environment as it is, it became increasingly important that growth be cash flow positive, and there were quite a few things in my portfolio that were not cash flow positive, and got hurt really quite badly during Q1. But I'm still really optimistic. The picture there is of Ubiquity, which is a position that I really started to ramp up my allocation for during Q4 and even through Q1 as well. Actually, I was planning to write a post about this, but someone else wrote one on eToro recently, so you can go and check that out if you want. Then direct to consumer is another trend that I was looking at, and really it's not just direct to consumer, but really just some of the disruptors in some of the slightly more stagnant markets. And Lovesac is a company that I found that I think is really doing that in kind of the world of sofas and beanbags, I guess, but mainly in sofas these days. I wrote a really long post about them on eToro. If you want to go and check it out, I built up that position through Q4. Again, they got hit really, really hard through Q1, but I actually think that's pretty unjustified, really, looking at the fact that they're, company with good cash flow and really, really strong growth. And if you look at some of the analysts' estimates for the company, they're just getting more and more bullish. So this is one of those companies that I think actually got dragged down with the market through Q1, but that was something that I was building up in Q4 as well. Hedging and dividends, I mentioned it earlier. So increasing the amount of trades I was doing on SQQQ and things like that to try and have at least somewhat of a long short effect on the portfolio, where I'm long on the individual stocks that I'm bullish on and I'm short on the market overall during periods where I think it's slightly overvalued and is due to retrace. It's a bit of a risky game, which is why I do it with a lesser part of the portfolio. But yeah, in Q4, to be honest, it didn't really work out that well. I had I think the first month or so I was doing really quite well with those hedges, but it didn't work out too well through that quarter. Actually, normally my hedging goes quite well, and this quarter it's gone pretty well for the positions that I've done it with. It's just been too small of an allocation to really help the portfolio too much. But during Q4, they just went against me more often than for me, sadly. So I think I was slightly down. I mean, not much, but slightly down on my hedging trades through the quarter. And the last thing really is transport and industrials. I've talked a lot about the rail companies that I'm invested in, CSX, Union Pacific, Wabtec, who just had their earnings this morning, which is a locomotive company. Also, obviously, investing in several car companies. They like to Ford. Ford had an amazing quarter. I think they're up by around 50%. We'll talk about that a bit more later on as well. And then the industrials, so like ABB Automation and Siemens and companies like that we have exposure to in the portfolio. Pretty good, resilient companies that are going to be part of a lot of the kind of rebuilding that's going on, and really the people that have received a lot of the funding from governments to kind of build up new infrastructure. And I really think that transport generally is kind of undergoing a bit of a revolution at the moment, and a lot of money is moving in that direction. So looking at the benchmarks for how he actually did on that quarter, so as you can see, I underperformed most things. There's no real other way of putting it. I mean, we did beat the Russell, which was hammered through the quarter. We were roughly in line with the European markets, although you can argue that the reason the FTSE did so well is probably just because of oil prices, and the same with Dow Jones. Well, Dow Jones isn't listed here. Crypto didn't have a great period. I reduced exposure to crypto quite a bit through Q4, especially in early December, late November. Reduced my allocation dramatically, between around 40 and 50k. for the most part. So I'm pretty happy with that, because really it was a pretty bad quarter. But yeah, overall, I don't think there's really too much to say here, except that the markets were a bit weird, really. There was rotations into and out of growth stocks, and into value stocks, and um, yeah, I mean, I don't know what to say, really. It's companies that to be honest, I still kind of feel like a lot of the moves that went on were not really that well justified, and I think we've started to see that a bit in earnings that are going on at the moment. We're starting to see some of the companies that were really punished through the past 6 months actually delivering pretty decent earnings, and justifying their valuations a bit more. But yeah, we did underperform at the end of the day, so there's not much I can say about it, really. I'm not too happy with it. I think part of that was obviously due to our position in Peloton. They had a pretty disastrous quarter, and again, we'll talk about that a bit later on. For 2021 overall, it wasn't so bad. We outperformed everything in Europe. We did pretty well against crypto overall, considering the allocation that we have. We outperformed it, I guess you could say, because my allocation is only around 10 to 15% throughout the year, 15% maximum. It's actually closer to 5% most of the time. So we did pretty well against the cryptos. We beat Europe. We beat the Russell as well, and we weren't too far behind the Nasdaq and the S&P 500. I think it's also worth pointing out that this has kind of been a weird year. The S&P does not normally make this much money in a single year, and I think it's really a kind of combination of the rotation that we saw into value stocks, and especially, I guess, US-based value stocks. The growth of oil, and fossil fuels, which we couldn't invest in, and I think a lot of what was going on with opening up and closing down again and opening up again throughout the year as well. But again, like it's not a result that I'm particularly happy with, to be honest. We underperformed at the end of the day. There's no other way of putting it. I do like to think long term, and of course, if I were to put some other benchmarks on here, I think some that would be really valuable would be TAN, FAN, and HYDR, which is a hydrogen ETF, wind ETF, and solar ETF, all of which lost money through the year, and performed pretty badly. Some of them, down by a substantial amount, actually. And considering that we had really high exposure to that throughout the year, and especially in the first half, I'm really not too upset with the performance, because if I were to build like a proper composite benchmark, then I think we would probably have outperformed the sectors that we're exposed to. Even though we didn't beat the benchmarks that I want to beat, which is mainly the Nasdaq 100, but also the S&P 500. I will answer questions at the end, by the way, as I'm sure the mods have been informing everyone. How are we doing on time? Okay, not too bad. So for market highlights during Q4, I think there's a few pretty obvious trends that we can identify. First of all, the Santa slowdown. Everyone was hoping for the Santa rally, myself included. Had a lot of exposure to companies like Etsy going into the festive period, and Etsy is again one of those companies that's really been hurt quite badly over the past 6 months or so. And yeah, I'm not sure that investors were really expecting this, but because it felt like there was a lot of savings with consumers, and that spending would continue to be high. But it seems like that wasn't really the case, and we saw the markets really drop off in November and December. Same thing happened with crypto. It rallied right at the start of this period, and then plateaued a bit, and then dropped quite dramatically towards the end, after just about pushing for new highs. So yeah, I'm pretty, as I said earlier, pretty happy with how we handled the crypto side of things, though. We got out not at the top, but we got out at a reasonable position, and kind of waiting on the sidelines for the time being, with only minimal exposure. Not sure what's going on there. Why my sound just turned itself up. In terms of Omicron, again, this was a big driver through the period. I kind of talked about this earlier, so I don't think there's really much extra I can say about it. We were watching it as it kind of unfolded and was spreading and waiting for the data to come in. There were some pretty major lockdowns and pushes for more vaccination going into winter, especially in Europe. We're only now really even seeing it start to spread in countries like Australia and New Zealand and China. So yeah, it's still kind of an ongoing situation actually, and as much as I think society is kind of pushing towards this post-COVID world, in reality, it is still an ongoing situation, and because of how rapidly it is spreading, there's always the chance that more variants could kind of formulate, I guess, or mutate, I guess is the correct word. We could mutate new variants, and those new variants, although usually they should be milder, there is still a very real risk that that won't be the case. So that's something that's still going to be a theme through 2022, I think. As much as everyone's really focused on inflation, COVID isn't actually gone, and it is still lurking and still likely to cause some disruption in some form or another. Inflation is, of course, the big one. So inflation runs hot is what I've titled it, and that's pretty much it, really. I think Q4 was really the point at which we saw inflation numbers start to get to a point where investors started to become really concerned about it, and the Fed had to respond to that, and they changed their language from transitory to actually it's not transitory and it's actually a problem, and really only this year they seem to be starting to address that. The last two energy price surges, we talked about that earlier, especially in Europe. Electricity bills, gas bills going up, fuel prices as well. This has a major effect on logistics companies, on manufacturing. Luckily, that's not too big in Europe for the most part, which is where most of that problem seems to be. But I mean, we've also seen problems in Kazakhstan and areas like that, which is affecting uranium prices. We're likely to see it in Texas at the moment. So it's kind of an ongoing theme, to be honest, of this kind of scarcity of energy. Partially through transitioning to more sustainable energy, and partially just due to the kind of monopolies that there are in the oil and gas markets from the big names. And then last of all, there's COVID stocks. So the likes of Zoom and Teladoc and Peloton just completely unraveled during this quarter. And I think really a lot of it kind of to some extent, Peloton was really a catalyst for it accelerating. So they'd had a pretty bad year already, but things went from bad to worse. And we did have exposure to Peloton, didn't have exposure to things like Zoom and stuff like that, but really a pretty poor quarter for those kind of companies. So looking at some individual kind of highlights, I guess, from the quarter. The first one, I talked about it earlier, exiting crypto. We cut exposure quite substantially. We also did make some good money from some of the new listings that were added. And you'll notice in the tags that I put below the crypto that yes, there are some altcoins and the normal kind of exposure to Bitcoin and Ethereum, but also Overstock, MicroStrategy, and Coinbase are in there as well. And all three of those are pretty good ways of getting exposure without paying such high spreads. I mean, you could argue Tesla as well is also an option, but really, I think their valuation is much more derived from the rest of their business than their crypto holdings. But these were other good ways of playing on those themes. And I think we're starting to see this kind of expand even further now. I mean, not only are more people putting it on their balance sheets now, but with what's going on with NFTs especially, things are really starting to get pretty wild. And part of the reason that I put the McDonald's thing there is not only did McDonald's kind of troll the internet about and kind of poke fun at themselves with the whole joke about crypto traders going to get a job at McDonald's because they've lost all of their money. But they're actually getting into the NFT space as well, which is kind of amusing. So I thought I'd put that picture there just for fun. Peloton losses. So yeah, this is the elephant in my portfolio as I described it in the post that I wrote about it back in I think it was November when the earnings came out. It might have been October. Yeah, absolutely monumental losses, massive failures in management. I said at the time I actually live streamed the earnings call for this on my Discord server. So I was talking through it, and my thoughts were very clearly that they immediately needed to cut back on their stores. They probably needed to cut back on their production, and to be honest, they probably needed a change of management. And I figured that I would cut the position pretty dramatically, which I did. This is one of our biggest positions. It's responsible for a major chunk of loss in the portfolio, at least 3%, somewhere around 3.5% maybe. But yeah, it was frankly disastrous management. I think as much as I think the CEO really does mean well, he was overly optimistic. Really, not enough control over the pricing of the cost of producing the bikes. The treadmill incident wasn't handled as well as it could have been, but that's in the past now. I still think that the brand is really strong. I still think that the business model actually makes sense. I still think it's going to be a profitable company. It's going to survive. It might get acquired. Certainly don't think it's going to be by Amazon. But yeah, pretty bad period overall. And I cut exposure, and I decided that I would wait until this earnings to see what they had managed to change and how much they'd managed to salvage of the situation before getting out entirely, because I still believe, as I said, that the company can work. But this quarter was again pretty disastrous, and they did start taking the steps that I said that they should take. Not long after the earnings release, we saw the CEO will be heading out of that role, and that's good for the company. But unfortunately, the damage is done now. Stock's down by over 90% from its highs. It's actually a pretty reasonable valuation now, but for the time being, I'm waiting on the sidelines until I can see real signs of a good change in that company. On the flip side to that, we had Ford, which was pretty incredible. As I said, up around 50% almost in Q4. My largest holding by far. I massively increased exposure to it in Q3. I increased exposure by 30% during Q3, which was in my my update prior to this one. And yeah, I still look at it now, and I still think they're in a really good situation. The blockade in Canada is currently affecting their production. The semiconductor shortage is obviously affecting production. So they did make some cuts recently in their estimates, but overall, still really bullish on the company. Pre-orders for the F-150 are through the roof. Yeah, the company's making all the right moves. The management is throwing their own money into the company behind it. They're all backing it. So yeah, I don't really have anything too negative to say about them, really. Yeah, definitely the redeeming pick of the year for me. And then last of all, small cap exposure. So I added exposure to a lot of small caps. Some of them smaller than others. It depends what you define as small cap. I'm a bit more limited in what I can invest in on eToro, so I kind of consider companies like UI and stuff to be reasonably small cap as well, although it's actually reasonably large valuation. And Corsair, which just got added to the S&P today or yesterday, which is why it's up so much. But yeah, Lovesac, UI, Arrival, Sunrun, SunPower. Yeah, there's a bunch more that I could list as well. And again, I really feel like if you look at the performance of how a lot of these companies have performed through the year, and how the Russell has performed over the past year or two compared to the big boys, I think we're reaching a point where those names are starting to become quite discounted. So that's why I've been adding exposure. So Arrival is the one that I've added most recently from that list. But I've been holding on to Corsair and things like that for a pretty long time. But yeah, I added exposure to these companies, and hoping that this year we'll start to see some good results coming from them. So for Q1, looking into this year, which we're already in, so in some ways, I could have just cheated on this slide and written down exactly what's happened, but I didn't, because I'm very honest like that. Rate hikes are obviously the thing that everyone's looking at. Rate hikes coming in the US. Rate hikes are already arriving in the UK. They're on the horizon in Europe. Yeah, I mean, it just dramatically changes everything in terms of valuations of companies, really, because as I said earlier, the cost of capital is really the main change, right? So if you're a company that's in debt, then this is very, very bad news. You need to be a cash flow positive company right now, if you want to justify your valuation, and that's why we saw a lot of money rotating out of growth names, out of some of those riskier plays. At the same time as that, though, I don't think we're going to see like a 0.5 rate hike from the US or something like that. I'm pretty convinced that it's going to be a slow and steady rise of the rates, and I think everyone, including the Fed, is really waiting to see how effective it is at actually reducing inflation. So we'll see. See how that unfolds, but it's definitely one of the main things that we'll be watching through Q1 is how the first rate hike hits. Although actually, I think it's in Q2 that it actually hits. End of March, maybe. I'm not sure exactly on the date. I need to go and double check that. Energy prices, I still think this is going to be a big theme. It's not going away. Energy prices are really, really high, and they're going to stay really, really high, probably for a good another quarter or two in Europe. And then I also think that like we're on a general kind of upwards trajectory in terms of energy prices anyway. We should start to see oil and gas possibly come down a bit if the Russia situation does calm. But to some extent, part of me perhaps perhaps a little, I guess, cynically believes that part of the reason that Russia's even doing this was just to help lift oil and gas prices a bit more, and put on some pressure and hurt the economy of their neighbours a bit more, and all of that. And it's worked if that was the plan, I guess. We are seeing countries start to look at energy security a lot more seriously as well. So next up, working trends. I think, I could have written a few things here, but I think working trends is going to be one of the interesting ones. I talked earlier about how we're moving post-COVID, but not really moving post-COVID. But everyone's using that term, so I'm going to use it as well. People are returning to offices and going back to work, and that's going to impact markets in a lot of different ways. Perhaps there's going to be more money in commuting and how people travel to work. More money in the kind of things that people are buying to go to work and things like that. But also there's quite dramatic changes in how labor is being acquired and how it's being retained at companies at both the top and the bottom end of the spectrum. We're seeing staff demanding more from their companies. They're demanding better working conditions, higher pay, more perks, and at the top end, things like developers, for example, are incredibly high demand, and the same in finance world as well. We're seeing record price increases from the likes of Goldman Sachs and such to try and make sure that they retain talent. So this is an interesting kind of theme that's emerging, and it's going to be important to consider this when looking at companies that we're investing in, and where their staff are based, and how the company is really addressing making sure that they hold on to the talent that they need to continue building up their companies. So that's really other things that I'm kind of starting to look at in Q1. I mean, I say Q1 really; these are kind of themes for the year for the most part. Although I think the first two are really especially important this quarter. That's it. Before we start Q&A, just want to note that if you follow me on social media, my name is Jaynemesis, as you can see below. These are my social medias. On Instagram especially, there are an awful lot of people going around making fake accounts of me, trying to sell you things that are not from me, have nothing to do with me, almost certainly trying to scam you out of money. um, Feel free to swear at them. I fully condone swearing at people that try and scam people out of lots of money. I probably shouldn't be saying that, but um, yeah, it doesn't make me particularly happy. I've seen a lot of people have DM'd me over the past year or so who have actually been scammed by these guys. So please be vigilant on social media. You really don't need to DM me every time you see a new account. Trust me, I get a lot of DMs from everyone saying, "Did you know that this person's faking being you?" And so, yes, I know. You're the 15th person to tell me today. So yeah, be really really careful, especially on Instagram. It's a good reason not to be investing in Meta as a company. I think if they can't control someone uploading the exact same images as me to their social media platform when I'm a verified account, I dread to think what they're going to do with the metaverse. To be honest. Um, so, yeah, be careful. That's it. I'm happy to answer a few questions now. As I said, like we can go up until around 6, but we'll see how many questions there are from you guys. Try and keep it related to the quarter or to 2021 if you can, rather than 2022. It's kind of okay to ask a few things about 2022, but generally, if it's kind of beyond that, then it's probably better to save it for next week when I do a full-on Q&A where you can ask me pretty much anything. So yeah, let me know your questions and I'll start answering them. Yeah. Any questions? If there's no questions, then I can stop. That's also fine. But I'm scrolling up quickly just to see if anyone did ask any before. Let's see. Wish I could copy you again. Yeah. Do you think Lovesack could become another Peloton? It is possible. It is possible, but I think there's a few very, very, very key differences between the two companies that should be noted. First of all, the valuation. First of all, let's talk about cash flow, right? Peloton were not actually generating a profit, and Lovesack are. So that's the first thing. Lovesack are making a profit. They don't need to raise capital to continue to expand their business because they're already making money from their business. The second thing is the management, I guess. So where Peloton really struggled to kind of keep up with demand as demand was increasing and struggled to expand the product range and expand into new territories and really take advantage of what happened during COVID. Lovesack were the complete opposite. They actually did incredibly well during that period. They focused very, very hard on the supply chain side of things and making sure that they had good inventory and that they were able to get that inventory out to customers, in a very timely fashion. And like you can actually go and look at, I think, the earnings before last from them. They were talking about this a lot, and how they manage inventory and how they move it around between locations and such. They handled that situation really, really well. I guess the next thing is that they've pretty much always always beat expectations on their earnings for the past year or so. Nobody was expecting them to be profitable as quickly as they are, and they now are. Like Peloton, it does have like kind of this ecosystem of upselling, and it is somewhat premium product as well. But focused on ESG and stuff, I think it's a pretty compelling product in a market where there isn't much else in terms of disruption. I guess the next thing would be patents as well. Peloton do have some patents, and they're good, and they certainly have a good brand that's very defendable. But there are a lot of things they don't have patents on, and as such, it's the moat that they have is much smaller. It's quite easy for a competitor to directly compete with them. Lovesack actually have quite a lot of patents on the technology that they're using. and it is a bit more defendable. It's still, there's still going to be someone can invent a different type of modular sofa, right? And a different way of making things fit together and compressing things for transport and all of that kind of stuff. All these things that they have patents on. There's obviously going to be other ways of doing it, but the fact is that they have patented a lot of the technology that they're using. So I think they're in a safer position on that front. And then, as I said, valuations. Peloton to some extent became a bit of a meme stock and was picked up by a lot of retail investors, and the valuation was pretty lofty, as people really expected them to continue on that growth trajectory. Whereas if you look at how Lovesac have been growing, it's much more conservative. I mean, at the end of the day, they are still somewhat of a brick and mortar kind of company. They do have actual, real physical presence on the ground. And they've just been kind of spreading throughout the US. They're still a much smaller company, much lower market cap. So yeah, I don't think, of course there's a chance that it could end up going in the same sort of direction as Peloton. But you can say that about a lot of the companies that I've invested in, to be honest. You could have said that about my investment in AMD back in the day. They weren't really making money, and they were not in a good position. Most people thought the company would go bankrupt in 2016, 2017. So, if you want high returns, then you have to take some level of risk, and I think that the risk to reward for Lovesac is actually looking pretty appealing, to be honest. Let's see. He says, let's see. He's lost his place entirely. Where's the question I even got to? You always have almost 100% of funds invested with no cash left on the sideline for in case market dips. Would like to know your opinion about this. Yeah, there's a lot of studies on this actually, and generally speaking, trying to time the market doesn't work in 90% of scenarios. I find it's much better to be invested in stuff and then cut the things that aren't working and then reinvest that when you find a better opportunity and redistribute it, rather than have it sitting in cash. I mean, as long as you kind of consider that your investments are as liquid as cash, and you're willing to sell at a loss and you're willing to just sell at break even, if you find a better opportunity, which is what you should be doing, then there's really no point in holding it in cash, right? Cash isn't going to earn you anything at the end of the day. If there's so many opportunities out there, it's just a case of prioritizing the best ones, really, and making sure that it's still balanced within the portfolio. And I just don't see cash as a good option for that, even when you're in a correction like this most recent one. Instead of having cash, is still, I think, better off having it in some sort of a growth play if you're further down in the drop, or in maybe a stock that's got earnings coming up, or dividends due, or a stock that's just announced share buybacks, anything like that. Like, I just don't think that having it sat in cash is really that beneficial, to be honest. Yeah, and again, like if you look at the data, most people who just average money in over time or have their portfolio fully invested from the start outperform people who try and wait for a dip and then buy in at a dip, or try and get out when they think it's high and then buy back in later. Timing the market is just something that's not very effective. I'm not live every Wednesday, sorry. Let's see. Sorry, I scrolled a bit too far up, I think. Like to hear what do you think about Fiverr, Shopify, and PayPal? Okay, so PayPal I don't really have any real strong opinions on, to be honest. I think it's a market that's become increasingly crowded. The entire fintech space, to be honest, is getting really quite crowded now, and it's pretty high valuations. I do have a position in Square, but only really because they dropped so much, to be honest. Yeah, I think the fintech space is pretty busy on that side of things. What were the other two that you mentioned? So yeah, PayPal I don't really have anything too much to say on it. Fiverr is an interesting one. I mean, Upstart just posted their earnings yesterday, and it was a really substantial beat. I think they were up like 24% or something pre-market today. I don't know where it's actually landed now that markets are open. But that was pretty interesting. Fiverr is a company that I think has got an awful lot of growth potential. But at the same time, I think that there is a growing problem in terms of quality of content on there, and the health of content, similar to what I think actually is becoming more of an issue with Etsy as well recently. Shopify obviously commanded an absolutely ridiculous valuation for a really long time. I've been in and out of Shopify a few times. I was in it in 2017, and boy, do I wish I just held on to all of it, looking at how well it's performed. Yeah, I would say I'm pretty bullish on Shopify still, though. Now that the valuation's come down a bit, I think Shopify is possibly a pretty good pickup. I think Fiverr is not a bad pickup. I mean, I haven't looked at it recently. I haven't looked at it in probably like 3 or 4 months now. But I like the business model. I think they've got a really strong brand presence there, a good kind of head start in that market. I'm just, there are some current concerns about how the product's managed, really, and how much it will continue to scale, especially I think with the kind of trend of reopening as well that's starting to happen as well, with people going back to offices and things. I wonder if quite as much work will be outsourced as it was before. Although at the same time as that, the kind of demographic data we have of less people being born in the West these days, and high demand for a lot of these really high skilled jobs and stuff. I can see outsourcing as a general kind of trend just continuing to grow as people outsource to Asia and parts of Africa as well. So yeah, I mean, there's still a really good like kind of business there, but I don't know. I think it needs a bit more exploration, not explanation, for me to kind of really properly look at investing in that area. But certainly, I think it wouldn't be a bad bet. I don't think, to pick up a couple of positions in those. Do you play with DeFi? Which project do you like the most? I don't really do any DeFi, to be honest. I do CFI instead, centralized finance. I really like Crypto.com's ecosystem, generally, which I consider to be CFI. I mean, they have a DeFi wallet as well, and you can do stuff on there. But if you actually compare the rates between what they'll give you on the normal earn program compared to the DeFi stuff, it's actually pretty similar. And for me, I think the security of having a company there that you can go and blame when things go wrong is probably preferable to trusting myself with DeFi. I've been in crypto long enough to know that controlling your own keys isn't always the best plan. Yeah, there's not really too many DeFi projects specifically that I really like. I think stuff like Decred, if you consider that DeFi, is pretty interesting. I still like Augur and Gnosis for prediction markets and stuff like that. Yeah, I mean, there's a lot of potential around it, but it's not really an area that I kind of explore too much, to be honest. Partially because it's not really available on eToro, although they've added a lot recently, so maybe I should start looking at it again. Any thoughts on Netflix? Almost cash flow positive and will likely remain so for quite a while. Yeah, I mean, there's been a lot of people kind of bashing Netflix recently, and obviously they dumped hard on their earnings, whereas Disney's earnings were looking pretty nice. I do wonder. I mean, like, it's definitely reaching a point where there's going to need to be some consolidation in the streaming market soon, with HBO and Disney and Roku and everything else under the sun, BBC iPlayer. There's a lot of options out there now, and I think one of the arguments that people are starting to make is that, realistically, you look at YouTube and you look at Netflix, and one of them spends billions on content and the other spends nothing. And also benefits from advertising revenue on top. So they have a subscription model and advertising. So, it's difficult, right? Because obviously YouTube's not its own company. But I do think that Netflix is starting to run out of growth. And I mean, that was the big scare from this last earnings report, right? Is that they stopped growing in some markets. And it's a question of like, are they starting to plateau? How long realistically can they keep pushing out this kind of content? It was a year ago, maybe even longer now, since they talked about moving potentially into gaming, and we've not really seen anything on that front. And I think, to be honest, I think Microsoft and Sony have such a head start in that sector anyway, that I just don't see any chance of success really in actual gaming for Netflix. But maybe I'm wrong. Yeah, I'm just not convinced, to be honest. I think actually a more compelling play is to go for that gaming play instead. I think Sony, after the recent Microsoft acquisition of Activision, there we go. That was a tongue twister. I think after that, Sony's looking pretty attractive. I still think Microsoft's pretty attractive, to be honest. I mean, they're looking into metaverse stuff. They're looking into dominating that gaming space, and Sony obviously will be trying to defend their turf in the gaming space, and their consoles doing much better. And kind of the merging of PC gaming and console gaming, and the kind of growth of their Stadia competitors of live streaming games to your device, mobile gaming. Like I think these are really if you're looking for growth, I think these are where the growth is now. If you're looking for something that's cash flow positive and still has growth, then yeah, I mean, I would rather go with Microsoft than Netflix. I think I find it hard to justify Netflix in that situation. I mean, Microsoft even pays me a dividend. Not that it's really anything to scream and shout about, but yeah, I think that's the problem for me. I compare it, because at the end of the day, right, it's one of the FANG stocks, one of the FANG mag, if you include, or Magna, as some people call it, or whatever. They're both in the FANG, and yeah, I compare it to Microsoft, and I just don't see it really. Uh, Return expectations for this year. That's a good question. Given where we are now, around 11% drawdown or so, I think probably looking at like 5 to 15%, maybe. But it's the number of risk factors this year. I mean, like if I had to pick a number, right, like I would say probably between that range. But there are so many risk factors this year. There's so many unknowns about how the market's going to react to interest rates. I mean, I'm still pretty optimistic, honestly. I think that the market's kind of overdone it a bit, and so I do think that we are going to rebound once we finally get to see that things aren't as bad as everyone thought it was going to be. But at the end of the day, we've got to wait for that to happen, right? And the market may not come to that conclusion for 3 months or 6 months or 18 months. And so, we're in for a very, very bumpy year, very, very rocky year. It really depends on how good some of my picks are. If Ford can deliver, if the semiconductors, AMD, NVIDIA, TSMC, if they can deliver, like that's why we invest in these growth things, right? It's to try and outperform what the market's going to do. I think the market's going to be around break even, or maybe up to 5% or so. So yeah, my target would be to be above that, obviously, which is why I said 5 to 15%, which it's in the grand scheme of things, when you look at the historical returns of the S&P and stuff, it's not that bad. And I think when you consider the kind of unprecedented market conditions that we're in at the moment, it's not too bad of a return. But as interest rates go up, that return may become less attractive to people. So yeah, who knows? I've not really given you a very good answer there. I'm sorry, but it's not an easy thing to give a good answer to, I guess. I missed one. What do you think about Facebook metaverse? Will it go back to 300 in a year, or you doubt it will fall in the 190 range? Let me have a look at their price. Just so I actually the chart, just to have an idea. Okay, yeah. I mean, I'm bearish on them, to be honest. I mean, I just told you my thoughts on Instagram. Facebook, obviously, part of the reason that they've done so badly, right, is that they're seeing that growth come to a grinding halt. And it's not surprising, right? They're massive, and part of the reason that they're going on this metaverse play is because they're massive, right? And they know that Zoomers and millennials don't like Facebook, and increasingly don't like Instagram, and don't like WhatsApp, and they don't have a captive a product that's capturing the kind of Zoomers yet. And that's a big problem. And I think that they recognize that the metaverse generally is going to be a big thing, and they've recognized it for a long time. I think Zuckerberg's always been a fan of that kind of vision. But at the end of the day, you got to look back at how they executed on their last crypto project, right? That ended in disaster. They wasted a lot of money on that, and tried to make their own stablecoin, and it fell through entirely. I think when you look at how they actually manage Facebook and Instagram, and the criticisms of those platforms, right, and they cause mental health issues for people. They're addictive. There's all sorts. There's rampant scamming of all sorts, with false advertisements, with people hacking into people's accounts and stuff, and stealing data, and the way that they use your data, the way that you can't remove your account like that. I mean, there's so many things. If you watch some of the documentaries about it as well, that are bad about how they run social media. It's not a good product actually for society, really. And I don't think it really actually brings value to most people these days. I think Twitter and Nextdoor.com and products like that actually do a much better job of what Facebook was really originally designed to do. But yeah, well, yeah. So I guess to conclude, I don't know that I trust them to really deliver. To be honest, I think they kind of got somewhat lucky almost with Facebook, and then since then they've just acquired other good platforms. And they're spending so much money. I mean, this is a massive gamble, billions and billions every year they're spending on this metaverse play. And at the end of the day, does anyone really want to trust Facebook as the metaverse? I think most people in crypto would probably be a bit happier if it was using sand blocks, or Minecraft or whatever. And also, metaverse is such a loosely defined thing, right? I mean, what really counts as a metaverse? I mean, GTA is a metaverse. Well, metaverses have existed for a long time. It's just about, adding VR and stuff, and they have got an advantage on the VR front. But there's so much else, right? Like there's so many players in this space. Like for me, I think if from a stock perspective, do you want to benefit from this? Nvidia, go with a graphics company, or go with a cloud company. Microsoft Azure, and obviously they own Minecraft. They have that Zoomer audience already, right? Or Roblox, all of these guys, I think are actually probably better play. You do better off by just spreading some bets across these other names, I think, than putting it in metaverse, in meta, I would say at least. Or looking into the actual crypto projects themselves, like Sand and stuff like that. But it's a big subject. Could talk about that at length. What is your view on Chinese companies like Alibaba, Tencent? Could they be good investment at the moment, or are they pose bad risk to reward ratio? I actually think they're really pretty solid risk to reward ratio. The real question is, how soon is it likely to pay off? And really, that's what's held me back from investing in China for the past year or so, when a lot of other people have started to move into that space. A lot of other popular investors on eToro have started to move into that. I've kind of hesitated, and really that's the reason why. Is I'm just not convinced that the West is really willing to work with them very much at the moment. I think Tencent especially has got a really good bet. I mean, talking about metaverse plays, I mean, these guys own an awful lot of big brands in gaming and media. I mean, yeah, there's a lot that they're in on. I mean, I believe they're majority owners of Epic Games as well, which is obviously one of the leading engines that a lot of people are going to be building stuff on in these metaverses. probably the best engine out there. I mean, it's also being used in film and stuff, and obviously they've got lots of investments in that space. Yeah, I think Tencent, Alibaba. I mean, those are actually probably the two that I would consider to be some of the most attractive investments in that region at the moment. Tencent especially, I think, but with Tencent, it depends on your ESG kind of view on it. And Alibaba, I suppose. But yeah, there's definitely opportunity there. But it's just about what your time horizon is. Where am I? I've been all over the place with these questions. I'm not reading these in order whatsoever. Pretty sure you have some Starbucks shares. Ah, dear. I don't actually. Comment on holdings in renewables in your portfolio. Enphase, Ørsted, Vestas, how they performed and your expectations. Yeah, I mean, they performed terribly. Overall, Enphase did okay. Enphase did okay. SolarEdge reported their earnings yesterday. I haven't properly delved into them yet, but they seem basically kind of like on target-ish, but with good forward guidance, which is what I'm expecting. Enphase handled the semiconductor situation much better than I thought they would. The situation with Vestas and Ørsted, I mean, actually, I would be buying more of them at the moment, but struggling for liquidity at the moment. Well, maybe not now, but like a few days ago, I was looking at buying more. Since then, they've both rallied by like, I think VWS was up by like 8% yesterday or something. Yeah, I mean, they've really struggled. They've really struggled raising commodity prices. The fact that, people are booking in these projects years in advance, and then by the time they're actually coming to get delivered, the interest rate situation and inflation situation has changed so much, and the cost of labor even in getting it right. People are putting in orders for wind turbines, and then a year and a half later they get their order from Ørsted or whoever, and the price is higher, right? They're making it a loss because they gave the quote a year and a half ago, and in a year and a half, the cost of producing and delivering those products has dramatically increased. So yeah, they've ended up quite out of pocket as a result. So I guess in the renewable space, the place to be really has been in the owners and operators rather than the producers and kind of service market, I guess. Like SGRE, Siemens Gamsa, they also had a dreadful year. But demand is still very much there. And if you actually kind of zoom out a bit and you look at China, for example, the biggest wind producer in China had an absolutely fantastic year. Did incredible. And part of that is because they were able to control their cost better, partially due to scale and partially due to being in China, where they weren't as affected by the rising commodity prices and such, and rising labor costs. But yeah, I think when you look at it in that context, and knowing that these things will come under control soon, I think that they're still reasonably compelling investments. To be honest, I think yeah, I still think that they're good bets. Wind is definitely the more risky than solar at the moment, though, I would say, because those commodity prices are just so much more important. I mean, there's so much steel and copper used in offshore wind. And onshore wind is kind of dead at this point anyway. Nobody's building onshore wind unless they have too much land, I guess, because it's just not as cost effective these days in most cases, and all the good sites have already been taken. I hope that answers your question. I mean, it's not like a really in-depth answer, but really that's the kind of core of it. I'm gonna answer. Let's see, I'll answer a few more. Netflix, YouTube. Let me try. No one comes close, really. Continue to dominate the market. Yeah, I mean, Netflix is going to continue to dominate the market, but are they going to make a profit while they do it? That's the question. That is the question. I invest in quite a lot of PIs since 2020, but your copy still performs the best, even in this bumpy time, while other big PI names are in deep red. Well, I mean, there's other PIs that are doing a lot better than me in the past 3 months, certainly. But yeah, I appreciate that. Meta has the ability to buy their way out with acquisitions again. Yeah, they do. That's very true. But will other people want to sell? Maybe. Roblox is interesting. Have you considered investing in it? Yeah, I've considered it. Find ESG issues are playing a larger part in your decision making. The requirement on large corporates only seems to be getting bigger. I wouldn't say it's really got bigger. It's got more difficult though, because more companies are putting stuff out now, and there's a lot of greenwashing, especially like the social side of it, like the corporate social welfare side of it isn't too bad. The governance side of it isn't too bad. I think companies have been kind of on top of, especially the governance side of things, for a pretty long time. But really, it's the environmental stuff that really companies are pushing on now, and really, you know, it's an exercise in rebranding themselves to a large extent. And yeah, you know, it's just more difficult now because everyone's claiming that they're the best, they're working hardest, they're going to do it by this year and this year. And when you actually investigate the claims, like, you know, are they actually looking at the full supply chain? In many cases, that's not the case. I mean, like car companies are a pretty interesting example. I mean, you can argue stuff like Ford and VW still make petrol cars, and thus they're terrible, and thus they are terrible. So I'm speaking quite quickly. But when you look at what they're actually doing behind the scenes on the ESG side, it's pretty in depth, to be honest. I mean, they are properly vetting their entire supply chain, like really vetting it, to make sure that there's no child slavery, and that, you know, things are done in a sustainable way, and that the mines are for lithium products and cobalt and all of these things, you know, are sourced as responsibly as they possibly can be. Like, you know, there is actually a lot going on behind the scenes for those companies. But then you have other companies that just put out a thing saying that we're going to be, carbon neutral by 2030, and you know, they're not including in their calculations a lot of the kind of externalities of their business. So like you have to look at the actual numbers that they use for it. But most of these companies put out, like, it's starting to get a bit more standardized now, and kind of how they produce these reports. So it's, you know, it's getting harder, but it's getting easier. Like, it's harder because there's more stuff to sift through, but it's easier because it's becoming a bit more normal. Yeah. Which looks like it ties into this next person's question. I invested in INRG, which is global clean energy, and down quite a bit. Do you recommend staying in or a different ETF? Well, I'm in the same ETF actually, outside of eToro, with my lifetime ISA in the UK, in the same ETF. So I'm in there with you. I don't plan on getting rid of it, to be honest. I think it'll be fine in the long term. It's had a bad year, a bad 2 years actually, but you know, it will come back, I'm sure. Literally because it has to. I mean, it's essentially inevitable, really. Can you explain what concerns fall under governance in ESG terms? Yeah, so governance is really about essentially it's mainly around like the board of directors and stuff like that, and the interests in the company, and corruption potential, and stuff like that. So really that's what you're looking at, is like the management team, their track record, where they've been, what their other interests are. Like, really it's about the management team more than anything else. And I guess from that stems the corporate culture. So you're looking at the culture of the company as a whole, and you know, do they have this culture of kind of like bravado, alpha male competition? Everyone has to work 100-hour weeks and grind themselves to the core because the CEO does, right? Or is it a culture where actually, you know, they're managing the company in a sensible way that's not burning out staff, not burning out themselves, where there's very clear accountability for who's in charge of what, and so that when things go wrong, you know who is to blame and how to rectify it. So in many ways, it's it's important in terms of like the resiliency of the company, so that when stuff goes wrong, you can see how they address it and how it gets fixed. So yeah, I guess I mean that's kind of the simplified version of it, really. Yeah, the main thing is looking at management. Okay. Looks like it's starting to kind of fizzle out a bit, and we've been going for a while. So I see one more question here, so I'm going to answer that, and then we'll call it a day. He says, unable to speak. This happened before as well. Oh no, there we go. Okay, we're back. We're back. I knew that I'd have to like go through one of those weird, awkward, like try and speak and it doesn't work before my voice would actually come back. So that's out of the way now. We can continue. Yeah. So there's two more questions actually, not one. I know it's currently hard to judge. No, it's currently hard to judge, but should hospitality and airlines now not soon get major bumps with tourism picking up again, especially for coming summer? You phrased that really weirdly. Should hospitality and airlines now not soon? Now not soon? Now not soon? Not sure what that means. But I'm going to kind of guess at what it means. Yes, they should see a bump imminently. I think they're already starting to see the bump, to be honest. Airbnb came out with their earnings last night, really, really strong. I think if you look at Expedia, also had their earnings recently, really, really strong. I'm not sure if Booking.com's had theirs yet, but these companies have been rotated into quite a lot. The valuations, like the price to earnings ratio, price to sales ratio, and everything has kind of gone rocketing upwards because more and more people are buying into it, and the market cap's grown. So the valuation has got worse and worse as a result, right? And the price is appreciated. And the reason the price is appreciating is because people see it coming. And I'm one of those people. I hold Expedia and I also hold Airbnb. And yeah, I think those markets are due for recovery soon. To varying degrees, though, I think there is still very much kind of concern with the public about how and where they stay and what they do and how they travel. So I think airlines, airlines are a tough market anyway. To be honest, like it's really, really difficult to to make a profitable airline. Most of them just aren't. So that's a tough one. And also on the ESG front, they're going to be suffering from that as well, right? Like as in well, not on ESG, but the E from ESG, right? Environmental concerns are becoming bigger and bigger, and there's not anything on the near-term horizon that's going to save them in terms of emissions. So, yeah, airlines and probably cruise ships as well, even though cruise ships are fixable on that side of things. They're also generally used by older demographics more so, especially cruise ships. And because of COVID, we've sadly lost quite a lot of old people. So you could argue that their market is declining. When you think about it, like the boomer generation is the biggest generation, and the generation that had lots and lots and lots of disposable income, and that generation is now at the stage where they're going on those cruises. But they are essentially the next generation in line to pass away. I guess there's no easy way of talking about this. But yeah, and so the question is, are these companies, especially cruise liners, are they actually appealing to younger generations? Are they appealing to like, the 30 and 40-year-olds as much? That's I don't think they are, to be honest. I think they're going to struggle to keep up. I think the other thing is like in terms of accommodation, people are looking more and more at like renting entire like units, whether that be like an apartment or a house or something. So again, Airbnb is the biggest beneficiary for that. Although the other companies are kind of moving that direction. The same thing goes for like experiences. Experiences are, no longer is everyone just like booking, a sightseeing trip or an excursion or like, a museum and stuff. Like people prefer the kind of more personalized tours. And again, that's the likes of TripAdvisor and Airbnb that are a bit more trendy in offering that stuff. So I think that's, yeah, that's the other thing to be considering in that market is just looking at like, where's the future of spending going to be here, and who's actually moving in the direction to kind of to approach that audience. The last question, someone's asking more. Hey Jay, what do you think of ovnative right now? I don't know what that is. I'm scared to Google it, to be honest. I'm assuming it's OVV. Is that the ticker? Oh, they're trading in quite a lot of places. Okay, I'll have a quick look. I'll have a very quick look, but I mean, I'm not going to know anything amazing, I'm afraid. What was it? AVV. Oh, I can't even find it now. OVV, wasn't it? OVV. Maybe I should be aware of them. The valuations look pretty reasonable. It's oil, that's why. That's why I don't know about it. Because I don't trade oil. Yeah. I mean, there's nothing I can add to that. SARS. They're in Canada. Don't know. I mean, I guess they're going to sell a lot to the US. US isn't as desperate as other countries for it, though. So, yeah. Who knows? Nothing I can help you with on that one, I'm afraid. Is this the real Jay or the fake Jay? Okay. I think that does it for today. Looks like some of you have already started to leave anyway, so I'll call it here. Next week I'll be doing a full-on Q&A live stream with way more questions, and you can ask whatever you want, pretty much within reason. So feel free to come and watch me on that. If you're not following me on social media and you ever plan to, then I suggest just doing it now so that you don't get the wrong one. And just please remember, scammers, lots and lots of scammers. I'm never going to message you with an opportunity in crypto. Why would I do that? I've got enough to be doing. Yeah, so thanks for watching, everyone. Obviously, you can find me on eToro. If you haven't pressed follow or subscribe or whatever it is on YouTube and on Twitch, then go for it if you want, or don't. Doesn't bother me. But if you want to be notified, then you've got more chance of it if you do that. And of course, join the Discord if you haven't done so. The Discord community is pretty active. I try to talk there pretty regularly. Sometimes we just have kind of like hangout calls where we talk about an earnings call or something. So yeah, if you want to come and join it, then you can. It's totally free. I don't charge anything. I'm not one of these people that has a pay for group or anything like that. You can just come join and hang out. Don't have to copy me. You can just be in there lurking if you want, or you can or you can not. Up to you. So yeah, thanks for tuning in, everyone, and I will see you guys next time.